Thank you for joining our webinar. This morning, we will explore some of the business continuity operational challenges and successes community bankers encounter in meeting the safety needs of employees, and importantly, how they can meet the unique banking and credit needs of customers during the coronavirus pandemic emergency. I'm Tom Curry, a partner at Nutter and co-chair of our banking practice group, along with Ken Ehrlich and Mike Krebs. I'm very pleased to have Donna Boulanger, President and CEO of North Brookfield Savings Bank, as a panelist, along with Matt Hanaghan of counsel at Nutter. Donna is a longtime community banker and a Massachusetts banking industry leader. In addition to serving her Worcester County community and customers, Donna currently serves as Vice Chair of the Federal Home Loan Bank of Boston and as a Director of the Depositors Insurance Fund. Donna is also a past board member of the Massachusetts Bankers Association. Donna has graciously offered to share her coronavirus-related experience as a community banker. Matt Hanaghan is a senior member of Nutter's banking practice. Matt is an expert on bank regulatory and compliance matters and has a wealth of practical experience in guiding clients through complex matters. Let's look at why business continuity planning and execution is so important to the banking industry. Banking, unlike many other industries, is a transaction-based payments business. Customers expect transactions to continue smoothly, even in an emergency situation, and public confidence in the banking system actually requires it. Fortunately, the banking industry has had an opportunity to be tested in emergency situations. Just think of what the challenges were on September 11th, Hurricane Katrina, and Superstorm Sandy. The federal banking agencies, in light of the coronavirus situation, updated their interagency statement on pandemic planning in this past month. And there are differences between pandemic planning and traditional business continuity planning. Pandemic plan components of a business continuity plan are the following emphasis. Number one, the need to have a preventative program. You need to make sure that your employees, first of all, are able to perform the critical work of the bank. That means workers who are needed to process and maintain systems for processing transactions and services, such as payment, clearing, and settlement, and wholesale funding, and workers who are needed to provide consumer access to banking and lending services, including automated teller machines and to move currency and payments as well. Finally, you need workers who support financial operations, such as those doing data and security operation centers. You also have to have in place a documented strategy with scaling up for stages of a pandemic outbreak. As we've seen, it is an evolutionary process that the challenges grow as the pandemic spreads. You also need to have a comprehensive framework for facilities, systems, or procedures for those critical operations. Also, as in any type of business continuity planning strategy, you need a testing program where you can assess the effectiveness of your planning practices and, probably more importantly, your capabilities. Finally, as with which is always important, is you need to have an oversight program with ongoing review and updates to the pandemic plan to keep it up to date and relevant, including active management and board involvement. Let's turn to the next slide. Donna, could you explain for us what worked and what didn't work to resume business under the coronavirus pandemic emergency as it emerged?
Yes, good morning, Tom, and thank you for that. Following up on your comments regarding business continuity, I think we've all had learning experience through the weather-related events, and certainly that allowed us to find out what processes worked and what other contingencies we needed to have in place. So we were successful in addressing moving to remote working. So that worked very well for us. At North Brookfield, I'm fortunate to work with a very good senior team and line staff. So very quickly, the pandemic team analyzed critical departments, and we actually went 4 deep in terms of being able to run a department if necessary due to illness. So in addition to looking at the critical departments and determining who else needed remote access, we did something a little different, and we did it very quickly. So I know that everyone is rotating their workforce, but rather than rotating our workforce throughout the week, we're trying to make sure that we have individuals that are home and safe. So what we did is we divided our workforce into 2 teams, and we rotate the teams every 2 weeks. So we have staff in the bank, working remotely, and we have tellers that are not able to work remotely, that we are paying their full pay to stay home for those 2 weeks. Because we feel that based on the guidelines of the virus showing up, if you've had contact within 14 days, we thought that was the best way to keep our workforce safe and keep a supply of employees. So one of the other things that we did was we quickly looked at our inventory of health protection and cleaning supplies, because I think we all knew to have these supplies based on the SARS and H1N1. So fortunately, we had basic health protection. We just needed more of it, and we ordered it quickly. The other thing that's so important is communication. So our human resource department quickly developed many, many communication pieces. And those are sent out weekly to the staff. Some are daily. Some of the pieces are healthy tips, and some of them are how to work successfully remotely. The other thing we're doing is I have a management level conference call every day at 8:30. The purpose of that call is really to get an update so that we know what's working, what's not working, what resources do they need. So I think that having open communication has made everything very successful. I actually had an all-employee call today at 9 o'clock, and we will do that every 2 weeks as the teams rotate in and out.
Thank you, Donna. Could you explore a little bit more with us what didn't work for you at your bank?
Absolutely, Tom. So although we moved very quickly, I had someone say to me, they couldn't get the signal through the noise. And what they meant by that was because we didn't have clear communication as to what the expected impact of this was going to be, although we were successful in getting remote access set up for just about 90% of our staff, it put a lot of stress on the IT department and their team to do that. They were very successful in doing it for us, but they did lose about a week's time. And you hate to put that extra pressure on people when they're already stressed. The other item that we found is not knowing what the remote access employee had at their homes. What did they have for equipment? What did they have for internet access? So the biggest challenge for us in North Brookfield is that we're still a rural community where broadband is not available for everyone. So in those cases, we had the workers go to different sites so that we have the teams separated just in case we need the backups. So I think those are our learning experiences, and certainly as we go through this, there's going to be more challenges. It's a fluid situation, and as you said, the plan needs to adjust as we go along, Tom.
Thank you, Donna. How much experience from past business disruptions help you or not?
Well, we actually did learn a lot because initially Our experiences were weather related, and we actually had a 3-day outage several years ago due to an ice storm. And that's really when we had the biggest learning experience. And the fact of the matter is, from that experience, we learned that we had to put in a generator at the main office because otherwise we couldn't use remote access. So that was our biggest issue that we corrected. And I can't imagine what I would have done now had I not learned from that. So I think that there were experiences from those weather-related events that were very, very good. The other thing is that we will have people work remotely again in the future on an ongoing basis so they can continue to make sure that they have their skills, because the access may be different, whether it's to websites they're using or to files that they usually have on their desktops. So I think all of this will, in the end, be a good experience, and I think we're all up to the challenge.
Thank you, Donna. Turning to the next slide. The banking regulators and the CARES Act itself are encouraging banks to extend credit to individuals and businesses, particularly small businesses. They've put out a number of statements. The following is not an exhaustive list, but you should check the federal and state regulators' websites for additional relevant information. And I'd like to just briefly go through some of these federal regulatory pronouncements. I think one of the more significant statements was the interagency statement on loan modification and reporting for financial institutions working with customers affected by the coronavirus. And this really addresses the imminent situation that we're facing. Financial institutions are clearly encouraged by the regulators to work constructively with borrowers. And what's important, I think, to bankers is that the agencies have indicated that they will not criticize institutions for employing prudent loan modifications and will not direct institutions to automatically categorize any COVID-19 related loan modification as a troubled debt restructuring, which has potential impacts on reserves of an institution. Also, I think it was very helpful of the agencies to confirm with the FASB that short-term modifications made on a good faith basis in response to COVID-19 to current borrowers are not TDRs. The agencies also have expressed views in the interagency statement that borrowers of 1 to 4 family residential mortgages where loans are prudently underwritten and are not past due or in non-accrual status do not also result in being considered restructured or modified for the purposes of respective risk-based capital rules. And it also, the statement also views prudent loan modifications to customers affected by COVID-19 as positive actions that can lead to improved loan performance and reduced credit risk, which is really an important consideration. And also, just yesterday, the FDIC issued Financial Institution Letter 33-2020, stating that the Paycheck Protection Program loans made in good faith will not be criticized by examiners. There's also the joint statement encouraging responsible small dollar lending in response to COVID-19. And again, this is an example of the regulators trying to provide some assurances to regulated institutions that there are some benefits and there will be an appropriate response from regulators. Here, they've made it clear that this type of activity will be considered positively for CRA consideration. Also, the Federal Reserve, specifically in a policy statement on changes in supervision, indicates that they will not be on site or examining bank holding companies or member banks that are under $100 billion in assets unless there's serious supervisory issues existing. And again, this is to permit banks to focus on meeting the credit and banking needs of their customers. The Massachusetts Division of Banks and the other federal regulators have also indicated that their supervision programs will not be conducted on site for the interim period. The Massachusetts Division of Banks, as I mentioned, has also issued pronouncements to indicate what the regulatory posture will be in the COVID-19 period we're experiencing. The division is, however, more focused on waivers, fee waivers, and borrower payment deferrals and credit reporting accommodations. And as you can see from this slide, they ask state-chartered banks to consider waiving ATM fees, overdraft fees, late payment fees on credit cards and loans, and early withdrawal penalties on time deposits. They also recommended actions which many banks have done, such as increasing ATM daily cash withdrawal limits, potentially easing restrictions on cashing non-customer checks, increasing credit limits for creditworthy borrowers on credit cards, and offering payment accommodations such as allowing borrowers to defer or skip some payments or extending the payment due date, which would avoid delinquencies and, importantly, avoid negative credit reporting information. There also are some statutory changes in response to the pandemic. Importantly is Section 4008 of the CARES Act, where the FDIC's debt guarantee authority from the last crisis has been reauthorized, and this could permit the FDIC in its discretion to authorize a temporary increase in FDIC insurance for non-interest-bearing transaction accounts until the end of this year. Again, this type of action is probably dependent upon another provision of the CARES Act, which authorizes the Treasury Department to support money market mutual funds. And it's likely that this type of action would only occur if the Treasury Secretary triggers that support for the money market mutual fund industry for competitive equality purposes. Section 4011 of the CARES Act also authorizes the Comptroller of the Currency to waive the OCC's lending limits until either the end of the year or until the earlier of whether the national emergency is terminated. This is again a discretionary authority for the Comptroller to increase the limit. It also raises another potential competitive equality issue for state-chartered banks. It is possible that additional extensions of Paycheck Protection Program credit or other credit extensions in terms of customer accommodations or borrower accommodations could cause a bank to go over its legal lending limit. Nutter is discussing this issue with the Division of Banks to determine whether the division has a similar authority or whether they could issue some supervisory guidance limiting its practical impact during the coronavirus pandemic. Lastly, Section 4012 authorizes a temporary reduction of the community bank leverage ratio, or CBLR. It lowers this ratio from its current 9% to 8% until the earlier of December 31 of this year, or until the national emergency is terminated. Again, these are all efforts to provide some reassurance that the regulators will be flexible as banks deal with the pressures of responding to the coronavirus pandemic. And now I'll turn it over to Matt Hanaghan, who will discuss other regulatory and legal considerations under the CARES Act. Matt?
Thank you, Tom. Section 4013 of the CARES Act provides temporary relief from TDR requirements that essentially codify the guidance that the federal banking agencies received from FASB staff. So under US GAAP, a bank can elect to suspend TDR treatment for loan modifications that are related to the COVID-19 pandemic, provided that the borrowers were current prior to the loan modification. And for these purposes, current means not more than 30 days past due as of December 31st, 2019. It's important to keep in mind that all TDRs are impaired, but not necessarily classified. And so if TDR treatment were required, that would necessitate making a determination on a loan-by-loan basis, whether to reserve for loan loss and to determine whether or not the loan itself should be classified. The relief is effective going back to the 1st of March and until either the end of this year or 60 days after the National Declaration of Emergency has been terminated. In addition, Section 4014 provides temporary relief from the CECL, the current expected credit losses accounting standard, until the end of the year or the date on which the national emergency is terminated. For banks that are not either publicly held or held by a publicly held holding company, this doesn't have much practical effect. The effective dates for CECL were dependent on whether the institution was a public business entity that's an SEC filer or a non-SEC filer. And for non-public business entities, the effective date was the end of 2021 in any event. We're going to turn to loan payment deferral programs. In terms of regulatory expectations, as Tom mentioned, the federal banking agencies are encouraging banks to consider any sort of accommodation that would be reasonable for customers who are experiencing financial hardship due to the pandemic. The Massachusetts Division of Banks, in its March 25th statement, went a little bit farther than that, saying that they fully expect banks to alleviate the adverse impact of the pandemic on particularly their mortgage borrowers who demonstrate that they're not able to make timely payments. And the federal and state banking regulators have issued various other statements encouraging banks to work constructively both with consumer and commercial borrowers. Prudent measures that are made consistent with safe and sound banking practices, the examiners assure us, won't be subject to criticism. And we talked about the customer accommodations that the banking agencies are recommending that banks consider. In terms of establishing a loan payment deferral program, particularly for consumers, it's important to consider what sort of compliance issues might arise depending on how the program is structured. The first thing that comes to mind is truth in lending. Is redisclosure required? And for closed-end loans, Regulation Z has an official commentary that gives us some helpful guidance. Where a loan is not being replaced by a new obligation, in other words, it's not refinanced, you don't need to treat this as a situation requiring redisclosure. And that comment specifically mentions that this includes deferrals of individual installments. It doesn't mean that you shouldn't disclose any changes in terms that will result from a loan modification given to someone adversely affected by COVID-19. There's some case law that suggests for purposes other than truth in lending, namely UDAP and other consumer protection laws like Massachusetts Chapter 93A, you still need to disclose any significant changes in terms. So if the loan modification will result in increased monthly payments after the deferral period, that needs to be disclosed to the borrower. If there's any other significant change to the loan terms, such as a balloon payment, that should be disclosed to the borrower, any increase in the finance charge. And the structure of the program could also implicate additional consumer protection terms. For example, under Massachusetts law, a loan that has a balloon payment feature is required to include additional terms that can be invoked at the option of the borrower to renew or extend the loan. So those kinds of things can be complicated. In particular, you want to avoid capitalization of unpaid interest. So one of the things that our clients have been dealing with is the question of a 30 or 60-day loan deferral on a home mortgage loan. Are you going to allow interest to accrue but waive the requirement to pay that on a timely basis and then spread that accrued but unpaid interest over the remaining payments of the loan, and perhaps tack on 2 or 3 payments at the end so that the loan will still fully amortize at the end of an extended maturity? Or are you going to forgive those interest payments? If you forgive the interest payments, of course, that's a more significant hit to income. But many of our clients are telling us that their systems are not set up to manage a loan with sort of restructuring the interest in this way without capitalizing it. And capitalizing interest is fraught with risk. There's Massachusetts common law that suggests it's unfair to charge compound interest to a consumer, so interest on interest. So we're recommending avoiding any sort of transaction terms that involve the capitalization of interest. And of course, there are fair lending concerns. You want to avoid any sort of terms that might even inadvertently result in either disparate treatment or disparate impact on a protected class. Disparate treatment meaning the inconsistent application of the loan deferral program in a way that has differing impacts on a protected class, whereas disparate impact is where the program is structured in a way that the consistent application of the program results in negative impact on a protected class. In terms of documentation, we're recommending that any sort of deferral program, particularly a deferral program for consumer borrowers, be approved by the board or a competent committee of the board. There should be a written loan modification agreement that clearly discloses what the new terms are and how the loan is modified. And disclosures of changes in terms can either be included in the loan modification agreement or in a separate written disclosure document that's provided to the borrower in writing. In particular, it's important to note that for open-end loans like HELOCs, the truth in lending requirements for a change in terms notice that require, under normal circumstances, 30 days advance notice for a change in terms do not apply where you're making a customer accommodation that's been requested by the customer. So your loan modification documents should also document that the customer is requesting the loan modification for purposes, especially of open-end loans, so that you're not subject to the 30-day advance notice requirement, and you can go ahead and make that loan modification effective immediately once the borrower has signed the documents. You also want to make sure, for purposes of taking advantage of the temporary suspension of TDR treatment, that you get an attestation from the borrower of financial hardship that's related to the COVID-19 pandemic to be sure that you fall within the temporary grace period provided under the CARES Act. And in any event, you need to consider whether the loan should be reported as a TDR. We're going to move on to the Paycheck Protection Program, which is an expanded Small Business Administration loan program under the umbrella of the Section 7A program. And I'd like to invite both Tom and Donna to interrupt me at any point during this part of the program, because this has been an evolving set of rules and expectations. It seems to change hour by hour. From a program overview standpoint, all existing SBA certified lenders have delegated authority starting today to start accepting PPP loan applications. The loans are fully guaranteed by the SBA, and any banks that are not already certified to process SBA loans as Section 7A lenders can apply for special authority to the SBA to be enrolled as a PPP lender only. And that's a much more streamlined process than being qualified under Section 7A. In terms of your borrowers, any business or nonprofit organization that has either 500 employees or less, or if they're in an industry that has a separately established size standard by the SBA, if they meet that size standard in terms of their employees, is eligible. That also includes, for these purposes, sole proprietors, independent contractors, and self-employed individuals, including so-called gig economy workers. The CARES Act requires that borrowers make a good faith certification that the loan is necessary due to the uncertainty of economic conditions caused by the pandemic to support their ongoing operations. And it has to acknowledge that the funds will be used, and the funds actually have to be used in part to retain workers, maintain payroll, and for other qualified purposes, such as making mortgage payments, lease payments, or utility payments that are necessary to keep the business running. The borrower does not have it, and they have to also certify that the borrower does not have an application pending for some other SBA program. For example, the SBA has a direct lending program for economic injury loans called the EIDL program. So borrowers who have received an EIDL loan are not eligible for the PPP and vice versa. The maximum amount of a loan is equivalent to 250% of the employer's average payroll costs during the period before the loan is made, or $10 million, whichever is less. Typical SBA borrower and lender fees are waived, and the SBA will be paying a small loan origination fee to the lender that's anywhere from 1% to 5% of the principal amount of the loan, depending on the size of the loan. No collateral or personal guarantees are required, and the CARES Act sets the maximum interest rate for PPP loans at 4%. The SBA originally set the interest rate at 50 basis points, and late yesterday, as a result of a good deal of complaining from SBA certified lenders, raised the interest rate to 1%, which is still significantly less than what's permitted under the CARES Act. The program permits borrowers to defer payments for 6 months and possibly up to a year. The interim final rule just came out yesterday, late in the day, and we're still in the process of reviewing it. It contains some changes to the program from what was originally indicated by the Treasury Department and the SBA. In particular, one of the concerns that many lenders had was that the SBA's guidance to lenders indicated that lenders would be on the hook for policing their borrowers. Essentially, that lenders would need to make certification to the SBA that the borrowers qualified in terms of their eligibility under the terms of the PPP program, that they had the requisite number of employees and that the funds would be used for the permitted purposes. So if it turned out that the borrower either made a mistake or, more likely, made a fraudulent application, there's potential for lender liability. The interim final rules that came out provide some protection for lenders. It seems that the SBA has walked back that position quite a bit, and they're now allowing lenders to rely on documentation provided by the borrowers, such as payroll tax filings and attestations by the borrower that they qualify as a borrower under the program and that they qualify for loan forgiveness provisions in the program. And the rules have indicated that the SBA will hold lenders harmless from mistake or fraud on the part of the borrower in that process. I mentioned loan forgiveness. The CARES Act provides for loan forgiveness for businesses that either retain employees or rehire employees that have been laid off as a result of the pandemic. Subject to certain conditions, borrowers will be eligible for forgiveness up to the entire amount of payroll costs and other qualified expenses during the 8-week period starting on the loan origination date. And forgiveness will be reduced proportionally by any reduction in employees or any reduction in pay of any employee beyond 25% of what their compensation was in the prior year. And in any event, the amount forgiven obviously may not exceed the original principal amount of the loan. And in particular, because under the tax code, debt that's forgiven is normally treated as income, the CARES Act includes a provision providing that forgiveness under the PPP program is not considered gross income for the borrower for federal tax purposes, making this a significantly more attractive program for your borrowers. It's also interesting to note that banks and other financial institutions are not eligible to borrow under the PPP program and are also not eligible for economic injury disaster loans or emergency grants under the SBA. There are some additional special considerations under the CARES Act and this program for SBA certified lenders, particularly that the CARES Act provides that the PPP loans you hold will receive a risk weighting of 0% for purposes of the regulatory capital rules, and that any modification to a PPP loan is also subject to an exemption from TDR classification for any PPP loan made on or after March 13th, 2020, which covers every loan under the program. And you can suspend TDR treatment for a modified PPP loan until the bank's primary federal regulator determines that it's appropriate to resume normal TDR treatment. Tom?
Matt, this is Donna. When you're talking about the CARES Act, what about the provision where an employer could obtain the 50% payroll tax credit? I don't think the banks qualify for that, do they? Because we were not subject to a government-mandated shutdown.
I agree with you, Donna. Not being a tax expert, I don't want to be held to that opinion. And Tom, if you feel differently, please let me know. But that's true. Banks are considered essential personnel under Governor Baker's order, and therefore they have not been forced to shut down, and are likely would not be able to benefit from that provision of the CARES Act.
Well, thank you for that. I think that when we're looking at our perspectives as community bankers, I think we all recognize the PPP program is a wonderful opportunity to help our commercial borrowers, but it's not, obviously that is not going to be enough because it is only 2.5 times payroll. So you have many customers, certainly I do, that 2.5 times payroll is not going to get them a good deal of money. So what we've done at the bank is basically outline all of the other SBA guaranteed loan programs that are available. And the reason that we did that, and we made information sheets, is that the lenders need to be well versed. So as we're looking at each of our borrowers and determining what kind of risk they're in, and then a risk to the bank, what other lending programs would they qualify for? So what we're doing is we are looking at our whole loan portfolio, but mostly focused right now on the commercial borrowers. And we're going to put them into segments. And we're looking at, you were operating at a profit before COVID-19, and you're still in good financial shape, and you're not going to be too distressed in this situation. The next thing we're doing proactively is then we're looking to see, you were in good shape before COVID-19, but you're going to be distressed, and you have the ability to recover and be able to support additional debt. Then we have the third group, and that's the group of borrowers that maybe were operating at break even. They don't have a lot of cushion. They can't take on more debt. So in those situations, we're going to need to look at what kind of loan modifications can we do for them. Because I think we all recognize that getting all of our borrowers in a good financial place only helps us in the long run as much as it helps the community. So on the consumer side, we do make small dollar consumer loans, and we will continue to do so. And what we've done in terms of underwriting guidelines is we typically would not use unemployment as a source of income to qualify a borrower. In these difficult times, we're certainly going to be using that. On the residential side, we have put in place all of our guidelines for loan modifications. We do have a board-approved policy. We're going to be proactive again there. We just need to make sure that we have different programs for the portfolio loans and for the sold loans. So all in all, I think as community bankers, we know our customers very well. And this is a time for us to really think about how we can tailor the best modification or new loan to ensure their success. So I think the earlier comment regarding legal lending limits and what's been done on the national basis is critically important to us as community bankers, many of us as state chartered organizations. I'm a small community bank. You all know that. I have several borrowers that are pretty close to the legal lending limit. We always did 80% of legal lending as our top amount that we would lend to one borrower. But in these difficult times, we may approach the legal lending limit and in some cases need to go over it. So Matt, I think it's really good that Nutter is working to get the Division of Banks to understand that on a temporary situation that might be necessary. I think it's unfortunate that we've all had to struggle with government regulations and changes to those regulations. Our lenders are working with a great deal of stress. So to have guidelines change at 9 o'clock on a Thursday night is difficult for people to keep up with. But I will tell you, I think that we're all up to the challenge. I think people have good staff and we should be able to help our borrowers.
I would encourage attendees to use the chat feature to submit any questions to the panelists. While we're waiting, I would like to ask Matt and Donna to talk a little bit more about Donna's most recent comment about the changing requirements for the Paycheck Protection Program and how that affects your ability to understand the rules, the legal ramifications of certain requirements that were initially offered by the SBA as well. So Matt, you want to talk from a legal practitioner standpoint, and then we'll ask Donna to expand upon her earlier comments rather.
Sure. I mentioned briefly during the program that Treasury and the SBA initially indicated that lenders would be on the hook for policing the program. And we learned only when the interim final rule was released late yesterday that they had walked that back. There have also been changes to the loan application itself. The initial draft of the loan application that went live earlier this week included some provisions that seemed to make borrowers ineligible if they had 20% owners who were not U.S. citizens, which caused a good deal of consternation among the lending community because it didn't seem fair to exclude borrowers who had non-controlling shareholders who didn't happen to be U.S. citizens. And fortunately, there was also a change at the last minute to the loan application that removed that certification requirement as well. And I know, Donna, these sorts of last minute changes have put a lot of stress on your loan officers.
That is absolutely correct. We were really ready to begin inputting loans, and we had done a lot of due diligence on the documentation that the customers had provided. And I think there was some concern about lender liability. But as I said earlier, we're a small bank, so we know our customers versus the national banks that were going to be getting online applications, and you had a lot of chance for fraud. But what it did do is we actually had a very early morning phone call to make sure that we had all read the updated guidance and to make sure that we had everything in place to be able to stop processing those loans. So we are processing loans this morning, and we early on developed a checklist. So although I myself personally can't go through all of the items that are on that checklist, the lenders did put together a checklist for two things. So the first half of the checklist was what's required from the borrower for the application. And then the bottom half of that checklist is what is going to be required from the borrower for loan forgiveness. So again, by the staff being a little proactive, reading all of the many resources, they have developed good tools that they can work with. So at this point, we are processing applications. We did have 75 borrowers that did express interest, but I would say less than 1/3 of them had all of the required documentation that was needed. So a bit of advice to everyone out there is it's like anything else. We need to take our time and make sure that we're processing the application correctly. I think the indemnity for lender liability was a big win for us. The other comment I would make is that as community bankers, we all know each other very well also. So what I'm planning to do is that once I get through my own backlog of customers that are looking to apply, if someone else needs my assistance, our bank is going to be willing to help them help their customers. So I think that that's only good business and a good idea to support each other through these difficult times.
Donna, I commend you for your willingness to collaborate with other banks to deliver services to other banks' customers. That's really laudable. We received one question through the chat function, and I'll read it aloud for everyone and then ask Matt or Donna to comment. The question is, what exactly is the payroll information needed to be submitted with the PPP application?
Yeah, the interim final rule gives some examples, but doesn't seem to be exhaustive in terms of the sort of documentation that's required. Donna, I'd appreciate your views on what you're requiring in terms of payroll information that needs to be submitted by your borrowers to verify the employees and their rates of compensation.
Matt, and it's different in each case. And what it comes down to is this. In many cases, we're getting the documentation with the actual calculations from their CPA firm. And if they're a true small business owner and they don't have an ongoing relationship, we're just getting the documentation from them in terms of number of employees, average wages. We can ask for payroll records. So I think that really the best thing for everyone to do is if you look at the guidance and you look at what you have received from not only the SBA, but if you look at the guidance you've received from the Boston law firms, that is really helpful in developing your checklist so that you make sure that you know what you're asking for.
And I think that's about the best you can do until the SBA issues any more detailed guidance about the documentation they expect lenders to obtain.
Thank you. We have one other question that came in, and again, this addresses something we mentioned briefly in the presentation regarding the CARES Act lending limit relief. And the question is whether that's a general relief for all borrowers or just a modification to the section allows the Comptroller to approve excess lending limits. And the follow-up question, which is something that both I and Donna mentioned, was are states able to use their wildcard authority to enact a comparable treatment under state law? So, Matt, do you want to start?
I'm sorry, Tom. My audio cut out for just a second.
Okay. All right. I'll offer an answer, and then you can add in. The provision of the CARES Act on the legal lending limit relief is a standalone provision that allows the Comptroller to, in his or her discretion, to increase the legal lending limit, and it would be done by an order. as opposed to a rule or regulation. And again, in terms of how that legal lending limit is applied would be left to the Comptroller's or OCC's discretion. The other part of the question, Matt, deals with whether or not the various states could utilize their wild card authorities or parity authorities to implement a similar program.
Yeah, and that's something that we've considered, and it's part of our conversation with the Division of Banks right now. Under Massachusetts law, in order to exercise parity authority, the activity that you're engaged in this case it would be exceeding your statutory lending limit, needs to be something that's not only permissible for a national bank or a federal savings association, but it also has to be an activity that is not otherwise impermissible under Massachusetts law. So given that the legal lending authority is expressly provided under Massachusetts statutes for Massachusetts chartered banks, that might be a hurdle that would be difficult to overcome. We're not sure whether the Commissioner of Banks feels that she has the authority to interpret the parity statute to provide that sort of relief.
Yeah, I think Matt, and I'd like your comments on this. I do think that if the Massachusetts Bank Commissioner or other state regulators don't have that wild card authority, that they consider issuing some type of regulatory guidance on how they will treat a particular loan during this coronavirus pandemic from a regulatory standpoint. Usually with a legal lending limit violation, it's listed as a violation, and the remedy is to bring it within the legal lending limit. Hopefully, the regulators will look favorably on, at a minimum, some guidance that there would not be adverse regulatory consequences of a legal lending limit violations similar to what Donna had talked about in her remarks earlier. Donna,
we certainly feel. Yeah,
sorry,
we certainly feel that a commitment to refrain from taking enforcement action in this situation would be warranted, particularly from a safety and soundness standpoint. There's very little credit risk to the banks under the PPP loan program, both because they're 100% guaranteed by the SBA and because most, if not all, of the principal is expected to be repaid through the loan forgiveness provisions. And any remaining balance after the loan forgiveness has been applied would be due within 2 years.
That's correct. I mean, that's an important point to note. Donna, do you have any other comments on the legal lending limit issue?
No, I think both of you have covered that. Thank you.
Okay. Thank you. Donna, going back to the initial part of our program, talking about the employee impacts, do you have any advice to other banks in terms of, really this is a trying circumstance for everyone, but I think employees in a essential business like banking are under even more stress. Can you elaborate a little bit more on how you're helping your employees cope?
Certainly, Tom. So as I said, one of the things that we did is we actually had an all-employee phone call this morning because our rotation will begin next week with the two different teams. So what we did is we asked for questions ahead of that phone call, and then between myself and my human resource director, we answered their questions. A lot of them focused on, is the branch and the headquarters going to be cleaned? Just basic questions. Is it going to be clean between the teams? And certainly those are people's fears, is that they've been home for 2 weeks. They want to make sure that they're coming into a safe work environment. So certainly we're doing that. The other thing that they're looking for are really the healthy tips. And we send those out daily, weekly. We sent one out this week telling people that when you're under stress, there are certain things you can do to help yourself, and they found those helpful. And I think just hearing from leadership makes them feel more comfortable, and realizes that we are all very concerned about their well-being and their safety, and certainly people are concerned about their incomes. So I said earlier that at this point, the bank is paying all of its staff, and we're paying tellers to stay home. But at this point, we feel that's the right thing to do. And the other thing that we're doing is we make sure that they have the personal protection equipment that they need. They were all given cleaning supplies for their own workstations and work areas. And they also all have gloves, and they all have masks. Because I'm sure that you're all seeing that possibly now the suggestion is going to be made that we wear a mask. Well, we need to make sure that our employees have that. And fortunately, we had those supplies already in-house, because I don't know what people will do to find them now. So I think it really comes down to just making sure that we're in contact with our staff and keeping lines of communication open. Makes people more comfortable.
Thank you, Donna. I think that's very helpful for other community banks. One last question before the program ends. What type of response have your frontline people or you received from your customers in your community in terms of your continuation of business during this difficult period? Have you received a lot of support?
Yes, I think initially, Tom, I think the customers were worried about whether or not they would have access to their banking services. So over the first few days, we did see people taking cash out. We did see more volume at the ATMs, but what we found is that has really calmed down. People are comfortable coming to the drive-ups. We open new accounts through the drive-ups. We close loans for consumers through our drive-up windows. We are not allowing people into the bank unless it's absolutely necessary. So if someone insists on getting into their safe deposit box, an appointment is made. They need to wear their own masks and their own gloves in order to come into the bank. But I think the community at large is very appreciative of everything that the community banks are doing, and we've gotten great feedback.
Well, thank you, Donna. I commend you for your level of preparedness and dedication to your customers and the continuation of very badly needed banking and credit services. With that, I'm going to conclude our webinar, and I remind everyone that we do have a link to Nutter's COVID-19 Task Force and Resources webpage that is updated on a regular basis with important news and information. And again, this particular webinar will be posted to that site as well. And in closing, I want to thank my panelists, Donna Boulanger from North Brookfield Savings Bank and Matt Hanaghan from Nutter. Thank you for a very informative session. Bye.